Nicolas Darvas originally trained as an economist at the University of Budapest in Hungary. However, after leaving Hungary, he became a well-known dancer. During his off hours as a dancer, he would read books on the stock market and the great speculators, and he began trading stocks in the 1950s. Darvas had invested his money into a few stocks which had hit their 52-week highs. He was astonished that the stocks continued to rise, making him a huge profit. While on tour of the world performing as a dancer, during a reported 18-month period, Darvas made over $2 million and ultimately wrote the book titled How I Made $2 Million in the Stock Market. The equivalent amount of money today is likely over $20 million. And in the book, he outlines his strategy, called the Darvas Box method. So, let's take a look. I want you to understand that I have not read the book. I will, but not necessarily in the near future. For now, this video is based on limited research. So, as this chart here from TradingSim.com indicates, the Darvas box is, well, based on boxes. Here's how it basically works. And understand that my explanation does not go along with this chart here. So view the chart, but don't expect the numbers to fit. All right, let's say you have a stock. And if the price of the stock is moving between, say, $30 and $35 per share, that defines the upper and lower limit of the box. If the stock price moved above 35 to, say, $36 per share, one buys the stock because it's now moving higher than the upper limit of the existing box, and hopefully to a higher new box. However, if the price dropped below $30 to, say, $29 per share, then the stock was moving down and would trigger a stop loss. So let's say the stock continued to move up and reaches $43 per share and drops down to about $40 per share. That is the next box as it trades within those limits, 43 and 40. The stock price can stay in a box for an extended period of time if it wants, as long as it doesn't drop below the low of the box and trigger the stop loss. It remains a buy candidate if it moves above the upper limit of that new box. And the strategy is to follow growth stocks and simply draw lines along highs and lows as the box limits, and then adjust those boxes upward as new highs and lows form. And understand that there are some more basic details like using volume, but this is just a simple starter. I believe the systems available on various trading forums out there, such as TD Ameritrade's Thinkorswim, but I don't use it, so you may have to go look around for a platform for yourself. But start with TD Ameritrade if you have an account there. So it is relatively straightforward, and one may wish to draw their own boxes, and you can do that, and we'll show you that a little bit later here. So let's go to another example. Okay, so now we're looking at another sample chart from TradingSim.com. And again, let me give you some steps. Let me add a bit more detail to it. Hopefully it's not too confusing. So you essentially, you start off with a stock that makes a new 52-week high. So after that new high is set, you have to wait for 3 consecutive trading days so that that new high is not exceeded, because if it's exceeded, then you still got to keep moving your top line up. All right, so if the new high is not exceeded, then that level becomes the top line of the new box. And the breakout point from the previous box leading to the new box and the new high now becomes the low of the new box. Let me repeat that again. If the new high is not exceeded, it becomes the top line of the new box. Now the breakout point leading from the previous box to this new high or new box now becomes the low of the new box. Hopefully that makes sense. And the idea is to try to buy the breakout of the box once it exceeds that high by a few points or so, but sell the low of the box if it's breached and you use a stop loss in selling. So you're always moving your stop loss up as you go from one box to the next box. And then you just simply add to the position as the stocks move higher into those new boxes. And as you can see here in this chart here, the boxes aren't necessarily squares, and they can be rectangular, they can be horizontal as well as vertical. And you just simply stair step on the way up. So it's kind of like other stock formations we've talked about when we talk about climbing the wall of worry. Essentially, it's a stair stepping on the way up. And it works best with growth stocks, and that's what he focused on. So let's now go to our charts, and I'll show you some more examples. So here we are looking at a 6-month daily chart on the spiders, the SPY, and using realtimestockquote.com. You look up here in the upper portion, if you can see my cursor, they have an annotation tool. So you just check that box, that annotation tool right there. And then here's your pull down menu, and you can pull that down. You can see you can do all sorts of different things here. I normally use freestyle, but for this, we're going to do rectangle. It's not really a rectangle. You can draw any kind of box that you want. All right, so now I'm not going to be going by the exact rules Darvas Box here. I'm just taking a look at this chart now for the first time. So let's just say we'll start in here at some point. You work through say a 52-week high or whatever. So let's just say that we are at a 52-week high. So you have to start the box at the upper left in order to draw it properly. That's the only way that the annotation will work, at least in the box. So you take that, you hold your cursor down, and you move over, and then you bring it down to, say, the limits of your box. All right, so now here in this next move, that's gone above the upper limits. So you're at a new high, and you head up here. And let's just say that this does qualify in that 3-day portion of the rules. So you start your next box here, and then you move it on down to that point there. Okay, and then once again, you have another breakout. It heads up, and the 3-day rule probably doesn't trigger until someplace in here. So let's draw your box right there, move it over, and then on down. Let's just put it someplace like that. Now, this move here, and perhaps this next day there, probably goes below a stop loss limit. But let's just say that you're not stopped out here at this point. Let's just say you forgot to put it in, and we continue on. And so your next box is perhaps through, this is a breakout at this point here. So your next box probably is someplace maybe in here. Again, you don't get stopped out, so it moves on up. Looking through here, I'm not sure if there's going to be that 3-day rule up until maybe someplace up in here. So let's draw your next box at that point there and bring it down to, say, something like that. All right, once you've got that box there, as you can see, this move here and certainly the subsequent moves down here go well below your box, and you probably do have a stop loss at this point in time, and you're probably triggered that stop loss and you're sold out. So you miss the move all the way down to this point here, so you don't have any of those losses. But of course, unless you get back in, you probably wouldn't get back in up until this point here, because again, you're looking for that 52-week high, and so the top of the previous box isn't exceeded until somewhere around here. And that still doesn't give you that 3-day rule, so you probably haven't moved back into the market as of yet. So looking at this chart and doing your own boxes with that annotation, really the important points of the strategy are this. Number one, you're creating your own strategy. Number two, you're ignoring Wall Street. And Darvas was on a world tour, and he didn't have newspapers or radio. He was just getting sent information from his broker that came through on a teletext or something like that. So he had blocked out all of Wall Street, and you've heard me talk about that several times. I don't listen to anybody at CNBC. I've unplugged all that stuff. So I ignore Wall Street, and that's a good idea for you too. But then also, if you want growth stocks, it's a reasonable type of strategy for a growth stock, and you have some volume issues in there too that I haven't really covered. But you can just imagine you want to use stocks that do have some high volume. You don't want low volume stocks because I think the system won't do as well in those circumstances. And then you don't listen to stock rumors or tips that you get either at the salon or at the gym. And then lastly, you're doing your study, and it helps keep you with a straight line and sticking with the rules of this strategy or your own strategy. And I think the lessons are out there, and it works for me, and that's exactly what I do with my system, and I've done pretty well. Is I set the system up and I stick with the rules, and it has helped me quite a bit. And the idea is to help you focus on the facts and not the hopes and the wishes or the wants of the TV pundits. So, a good strategy will also help your confidence when the doubt starts to creep into your thoughts. And those doubts will, I guarantee you, they have for everybody. We've all had those periods of weakness when you begin to doubt yourself. So, my suggestion is for you to create a strategy and stick to it. And if the Darvas box method works, well, stick with it. But don't mix in other formulas and don't stray from your method. Keep with the rules. Basically, it's the patience and the discipline of your method that you'll make money and you'll have success. And so my last suggestion for the day is if you want to remain in the dark about the markets and you just want to follow the TV drama, then don't subscribe to this channel. And for today, that's ChewDog Charts. Thank you.